We have land becoming more expensive. We have less people around to be able to build the houses, and the materials that go into a house becoming more expensive. Squeeze, squeeze, squeeze on margins. Episode number 41. Welcome back. This is the Expected Returns Podcast. My name is Stephen Luttman. I am a real estate investor and agent here in the capital region of New York State. We went on a bit of a hiatus, working on some projects that I hope to be sharing with you shortly. However, we have some fun topics today. We'll be covering half a century long mortgages, fintech entering the lending space, and builders not building. A lot of fun things for us to cover today. My name is Stephen Luttman. Let's get started. We'll go ahead and kick things off today with a conversation about the White House's recent proposal of 50-year mortgages being a way to help homeownership affordability. Now, for some context, the median mortgage payment today in 2025 is nearly double what it was just 5 years ago. So will extending the payment reschedule plan significantly alter homeownership affordability? We are going to look at both the pros and the cons of something like this being implemented. First stop is going to be just looking at the math behind a 30-year versus a hypothetical 50. The loan amount, for our example, is going to be $350,000. The interest rate, we can take the national average right now, which is right around 6.5 on a 30-year. Now, we're going to do a little bit of guesswork on what that would look like on a 50. We do know that the spread between a 15 and a 30 is almost always going to favor the 15 in terms of what's going to be the lower rate, just because the longer you want to borrow money, the more risk that means for the lender. And in order to properly compensate them for that risk, you pay a little bit of a premium in terms of the interest rate. So if the 30-year right now is 6.5%, we're going to assume that a 50-year could be had for 7%. And when we look at what the monthly payment, again, same dollar amount being borrowed at a slightly higher interest rate for a much longer duration, what does that mean in terms of your monthly obligation? And we see from a 30-year obligation repayment schedule, we have $2,200 monthly payment. Once we stretch that out to 50, that drops down to $2,100. So we're looking at a roughly $100 difference between 30 and a 50. There is a segment of the population where that $100 difference is going to be the difference between them not being homeowners and them being able to qualify for a loan. So that is not nothing. However, for a vast majority of households, that $100 spread is going to be inconsequential. It does not matter. So yes, we're dropping our monthly payment by $100, but we're only helping a very small number of people. If the goal is to get more people to qualify for mortgages, there is going to be some small segment of the population this is going to help, but again, it's going to be extremely small. When you've heard conversations about this in the news, this is certainly going to be the most attention-grabbing part, is the total interest paid during the duration of the loan. So when we're looking at borrowing $350,000 for 30 years, the interest portion that we're going to pay if we were to hold the loan that entire period is right around $450,000. Where it really jumps out is when we look at it from a 50-year payback. That number jumps roughly $500,000 to $913,000, which is nearly $600,000 more than what we originally borrowed. So it's an extremely attention-grabbing, it's egregious. What I want to look at is not just that, but we're also going to take a look at what's known as an amortization schedule. And this is just how your monthly payments are applied every single month. So when you make your payment to your bank, part of that goes towards interest, part of it goes towards reducing your principal. Every month it changes a little bit. The further down the schedule you go, the more goes towards principal. I want to look at, from a 30-year perspective, we're going to look at what happens at year 10, because we can talk about 30-year loans, 15-year, 50-year loans. The truth is that the average loan only lives for a shade under 10 years. And what I mean is that people either sell their houses or they refinance their loan to get a better rate or a lower. So the average loan, even though it's scheduled for 30 or it's scheduled to 15, actually only lives for right around 8. But we're going to say 10 year at year 10, what does it look like? So we had a 10 years worth of payments. So we take the monthly payment, multiply it by 10 years, multiplied by 12 payments each year. At year 10, we have paid $265,000 towards our loan after year 10. And the amount of equity, so the amount of loan that we started with versus what we're left with at the end of year 10, $53,000. So we have $53,000 worth of equity in our home at the end of year 10. When we take a look at it from a 50-year, again, same dollar amount being borrowed, we have $252,000 worth of total payments. So a little bit less of total payments. However, our equity position, so the amount of house that we owe, drops to $11,000. So think about that. We've made $252,000 worth of payments to the bank at the end of year 10. And what do we have to show for that? $11,000 worth of equity. And when we take into account what we're paying for repairs and taxes and insurance, we're almost certainly in a negative position at that point. You could very well make the case after year 10, maybe you should have been a renter. Maybe it makes more financial sense if we only have $11,000 worth of equity, maybe we should have been a renter. Now, if you happen to purchase in an area that is appreciating, so home values are increasing significantly, then the conversation shifts a little bit because, again, in this example, we're assuming zero appreciation. This is just how much of the loan we started with versus how much is left after year 10. So that's a little bit of a way to kind of look into it a little bit deeper in terms of not just what the total amount of interest spent is, because, again, these loans overwhelmingly do not see the end of their life. It gets paid off, refinanced, sold, however you want to look at it. But if you were to hold it for 10 years, $250,000 worth of payments gets you $11,000 worth of equity. Where the conversation shifts a little bit, because a lot of the coverage was overwhelmingly negative. It was very rare to see anything positive. One interesting way to look at it is, though, if you are one of the rare Americans that does hold on to their mortgage, so maybe 5, 10, 20 years into the future, rates just continue to go up and up, and you have this loan that you took out in 2025, your interest rate is very attractive versus what the market might be offering you at that point. Maybe you do hold on to it. You never move. You keep the same loan. Not a lot of people do that, but maybe you are one of the very rare. When we take a look at what the purchasing power of the US dollar is going to be doing, you could make the case that locking in a mortgage payment now and being able to keep that same payment for the next 50 years is an extremely powerful way to gain equity and take advantage of a US dollar that is continually going down and down in value. And what we might mean that is the average, what can you purchase for the American dollar? How much goods can you purchase? And when we take a look at, this is coming to us from the Federal Reserve, this is a graph of the purchasing power over the past 50 years. So for our 50-year mortgage, we're looking 50 years into the future. What has the US dollar done the past 50 years? And we see that the amount of goods that we're able to purchase is not only has it been going down, but it's going at an exponential rate. It's going down. So if we can lock in a payment today and hypothetically continue to make that payment, not just for 30 years or for 40 years, but up until year 50, that dollar we're going to be spending in year 40 and year 50 is going to have significantly less value than it does in 2025. So I think this is probably the best case to be made for why someone might be interested in a 50-year mortgage is if you don't intend to move, if you have expectations that interest rates are going to be significantly higher in the future, you're not going to be tempted to refinance. If you keep your loan, if you keep your house, and if you anticipate that inflation is going to be continuing at some rate and the value of the dollar is going to continue to go down, locking in your payment today could be extremely wise. But next, we'll pivot to a new entry in the mortgage market. Fintech company Robinhood recently announced that they would be rolling out mortgage options to their Robinhood Gold customers. Sounds pretty exciting. When we peel back the layers of the onion a little bit, we see that Robinhood is not actually opening a mortgage brokerage themselves. Instead, what they're doing is they're partnering with an existing lender, Sage Home Loans, who is a national player. I don't believe they have any brick and mortar locations. I believe it's all going to be online, similar to your Rocket mortgages, your Better mortgages. Everything's online, the servicing, the application, all done online. What do the two companies get out of this is the interesting part. So from Robinhood's perspective, they have 27 million US customers, 4 million of which are going to be your gold customers. And that is a monthly subscription fee or a yearly fee that you can pay. You get a better savings rate on any money that you have deposited with them. They offer a type of IRA match. enable to grow that base, because when we look at companies, what do they love? They love reoccurring revenue, right? Revenue that they can depend on every month to say to Wall Street, hey, this is the amount we can expect every month to come in. So in order to grow the Robinhood Gold, you need to be able to offer different offerings, right? Savings accounts are great. IRA matches are great. How do we keep making that better and better? And this is one way to do it. So by offering connections with a mortgage rate that they claim to be possibly up to 75 basis points below the national average, that's a great way to, again, turn those 27 million, grow that 4 million, the gold numbers. So that's from Robinhood's perspective, just increase the offerings, grow the gold membership. From Sage Home Loans, they now just got their name in front of those 27 million Robinhood account holders, which from someone that works in the real estate field, I've never heard of Home Loans before this article came out. So this is brand new to me, and I work in the industry. Think about all those millions and millions of people that are Robinhood account holders who are in their, if you look at the demographics between who is a Robinhood account holder, it's going to be people in their 30s, medium to high income earners, probably at the point where they're starting to do some home shopping. From Sage's perspective, they're getting in front of the exact population that they want to. These are higher income earners, people in their 30s that are transitioning into homeowners. So from Sage's perspective, this seems like it'd be a great deal. From Robinhood's perspective, again, if they can increase that reoccurring revenue and transition more people to gold members, that's a home run for them too. So on the surface, without knowing the numbers behind the deal, seems like this could potentially be a huge win-win for both parties. If I'm Sage, I'm a little bit nervous, because if this does go very well from Robinhood's perspective, it wouldn't shock me to see Robinhood start to roll out possibly their own brokerage at that point. Cut out the middleman, Sage, we don't need you anymore. We've established that there is a hunger, there is a need for our members for mortgage products. We no longer need you. You've proven that the product works. We're just going to do everything in-house. So for however long this relationship is going to last, again, Sage is getting exposure to tens of millions of new customers that they likely wouldn't have before. And from Robinhood's perspective, they're increasing the offerings for gold membership. So win-win, both parties. Wouldn't be shocked to see at some point Robinhood cut ties and say, we got it from here. And finally, we'll wrap up today with a conversation about whether home builders are to blame for why housing is so expensive. The president recently came out and accused the national home builders of sitting on millions and millions of vacant lots. The implication being, well, if you were to build homes on these lots, introduce them into the ecosystem, whether it's hundreds of thousands or millions of new homes, that's going to put downward pressure on prices. Suddenly everything's more affordable. I don't know where he sourced this 2 million vacant lot number. However, there are a couple charts I want to take a look at. First is monthly supply of new houses in the United States. This is when a builder is done building the house and they list it on the market for sale. This is how long it takes them to sell each incremental house. And when we take a look at a 5-year time horizon, it takes now double the amount of time to sell each individual house than it did 5 years ago. So it's taking longer and longer. So what that tells us is there's inventory out there. Builders are building, they're putting things on the market. It's just taking them longer and longer to be able to move that product, so then they can just transition to the next project on the time horizon. Next, we'll take a look at how greedy these builders actually are. So this is coming to us from a site called Macro Trends. We're looking at the net profit margins over the past 5 years for Lennar Home Builder, which is one of the largest home builders in the country. For our audio-only audience, we are looking at 3 charts: gross margin, operating margin, net margin, that are all top left to bottom right, meaning it is becoming less and less attractive each year to be a home builder. Why is this? Why is it that their margins are continually getting squeezed? Well, let's take a look at what goes into building a home. We have 3 major components, right? We have the land, we have the materials, and we have the labor to build it. Land values continue to go up and up. So it's becoming more and more expensive each year for builders to purchase the land in order to build the properties. Labor. We have a generation of people that skipped the trades, went to college. We're also looking at mass deportations. We are limiting the number of skilled labor that's in this country that's able to build houses. The less number of people that are here to build houses means salaries are going to go up. If there's a shortage of people, they can bid for their services. That means salaries are going to go up. It becomes more expensive to hire people. Salaries are continuing to go up. So the labor component is becoming more expensive. And from a material standpoint, tariffs, right? We have tariffs on lumber. We have tariffs on roofing materials and cabinets and appliances. Everything that goes into a house is becoming more expensive, whether you like tariffs or not, because of the import taxes coming in. So we have land becoming more expensive. We have less people around to be able to build the houses, and the materials that go into a house becoming more expensive. Squeeze on margins. And when we look at the stock price for Lennar and the stock market as a whole over the past year or 2 years has gone gangbusters. Not so much for Lennar. Lennar is actually significantly down over the past year, which is a stark contrast again to the market as a whole having such a great year. So when we're looking at, a president accusing home builders of sitting on all these vacant lots, well, one thing we do know is that home builders are not a charity. They are going to do what's in the best economic impact for their each individual companies. And if they thought that introducing another million homes into the ecosystem was going to be good for their bottom line, they would do so. But what they're looking at is the same chart we're looking at, which is we're putting houses out there. People just aren't buying them. So again, the home builders aren't charities. They are publicly traded companies that need to do what's in the shareholders' best interest. And if the margins are coming down, and if the homes that they're putting out there are taking longer and longer to sell, it would be crazy for them to suddenly start ramping up building and putting even more supply in, because the supply that's out there is not being absorbed. That's going to be it for today. Thanks for making it to the end. I hope you got something out of this. If you do want to connect, it's steven@sjlincoln.com is my email address. sjlincoln.com/book a call if you're interested in scheduling a phone or a Zoom conversation with myself. Great for anyone that's interested in real estate in the capital region, whether you are buying, selling, or looking to become an investor. We'd love to talk with you. Again, steven@sjlincoln.com, sjlincoln.com/book a call. That's it for today. We'll talk again soon.